All right. Welcome to this week's Taxes in Retirement Live. Today I will be discussing the tax implications of inheriting assets. We'll talk about the different kinds of assets that can be inherited and how they're taxed or not taxed. And that will naturally kind of parlay into planning, estate planning and tax planning for your assets and what to leave to who and why from the tax perspective of things. Should be super exciting with that said. So let me start with the dad jokes. Cody says, "Let's go!" Exclamation point, exclamation point, exclamation point. Thank you, Cody. I love the enthusiasm. All right, dad jokes. I had a priest perform an exorcism for my house, but I never paid the bill, so now it's repossessed. Came and took it. My math teacher called me average. How mean. Get it? Because mean means average in math speak. And finally, let's see, I got a few here. Let me see which one I think will end the strongest. Here we go. This one's pretty cool. Midwives deserve a lot of respect. They really help people out, physically. All right, that's the dad jokes. Let me, disclaimer, as always. So, this video is only general explanations and education. It's not specific tax, legal, investment advice. Before considering acting on anything you see or hear here, first consult with your tax, legal, or investment advisor. Thank you. Mavis says test. Yes, hi Mavis, I see you. Test, quiz, etc. So inherited assets. So this conversation will presumably, start to get into some technical aspects of estate planning. And I'm not a lawyer, nor do I pretend to play one on Facebook Live video streams. Plus, a lot of estate planning matters are specific state by state. Things are decided upon in your local court, like if and when you pass and your estate goes through the probate process. That's up to the local court, the court in the county where you live. So anyway, those rules and how they administer things can be different. So keep that in mind. What we're talking about tonight is generalities about the tax impact of things, and that I don't think there's any difference in taxation state by state. That's a federal thing for the most part. There's also a state inheritance taxes at state, so I take that back. So there's going to be a lot of uniqueness about what we're discussing tonight based on where you live, the state you live in. So keep that in mind. We'll just be discussing some sort of general taxation things here. So let's start, and as always, chime in with comments, questions along the way. Again, there's like a 20-second lag, so apologies for the delay. Let's start with the different asset types and what happens when you inherit them as the beneficiary, the person receiving them. We'll start with things from that angle. So first is call it qualified accounts. Those are IRAs, 401ks, 403bs, the Federal Thrift Savings Plan or TSP, 457 plans, the traditional tax deferred accounts. You put money in, generally get a tax deduction when you put the money in, but then it's taxed and potentially subject to penalty when you take it out. Those are qualified accounts. Roth IRAs are also qualified accounts. Very different flavor, obviously, because as you presumably know, when you contribute money to a Roth, you do not get a tax deduction up front, but the benefit is the money grows and comes out tax-free, assuming you meet a few qualifications. There's a handful of posts today in the group about conversions and 5-year holding periods and whatever. So there's always there's always various qualifications. It's not as simple as all money comes out tax-free from a Roth, because there are cases where it doesn't, but generally, if you hold it long enough and you're of a certain age, yes, Roth money all comes out tax-free. And then there's also I'll leave it there for now. So those are qualified accounts, and also health savings accounts are another form of qualified account, which I'll touch on. So let's start with inheriting a tax deferred account like a traditional IRA, traditional 401k, 403b, 457, or the federal TSP, Thrift Savings Plan. The important thing to know is, even though when you look at your account statement, you look at your balance sheet and you see a 401k or an IRA of $1 million, let's say, you view that as an asset. It's something you own. That's only partially true. In the eyes of the IRS, those are not assets, those are income. They're big pools of income. More specifically, it's a big pool of income that has not yet been taxed, meaning when you take it out, it's subject to tax. So when you see your $1 million quarterly statement for your IRA or 401k or whatever, it says $1 million. Not all million is actually yours, because that's a partnership with Uncle Sam where, for every dollar you take out, the government's going to take its cut. Now, the whole goal of this tax efficient retirement planning gig that I preach about here is how to minimize Uncle Sam's cut so that you keep more of that $1 million as opposed to giving up more than you have to of it to taxes. So anyway, that's that. The point is, like, those tax deferred accounts are not entirely yours. They're not assets technically. They're just not yet taxed income. That's how the IRS sees it. That's why whenever you take it out, you pay tax on it. And whoever you leave it to, whoever inherits it, he or she or they or it, or depending if it's an organization or whatever, need to pay tax on it, except for charities. Qualified charities don't pay tax on basically any form of income, I don't think, including inherited accounts that are tax deferred. But if you leave an IRA or beneficiary to a spouse, to a child, to some other relative, to some random friend, that money will all be taxable in that person's hands when they take it out. Okay, so those are tax deferred qualified accounts. Things got different with the rules of how and when you need to take it out, effective this year, January 1st, 2020. So there's something called the Secure Act that got signed. It was quite like a last minute, came out of nowhere, and got pushed through real fast at the end of December last year, called the Secure Act. And it was one of the biggest overhauls to retirement plan taxation and retirement plan rules in quite a while. Prior to the Secure Act becoming effective, so meaning if you inherited a tax deferred account prior to 2020, so any point through 2019 or earlier, generally speaking, you had the ability to do what's called a stretch, to stretch out your distributions from that inherited account. So like if someone left you $1 million IRA last year, let's say, you weren't forced to take that whole $1 million as income in that 1 year. The IRS will let you stretch it, and they'd let you stretch it based on how old you were at the time and therefore what your remaining life expectancy was. For example, someone who was 40 years old last year in 2019 and inherited an account from whoever, non-spouse for now, let's assume non-spouse. So you inherited an account from your parent or some other relative, and you're 40 years old, you'd be able to stretch that out over, I think it was like 43 or 44 years. So basically you can dribble out some money every year up until your mid-80s. And that's good because you could, you're not hit with this massive tax impact. Again, $1 million. You don't want to take all $1 million in that 1 year because that's $1 million of additional taxable income. That's going to put you up into the highest tax bracket federally, 37% last year. So it'd be better to have the ability to stretch that out over 40 something years. So you're only taking out, a few tens of thousands of dollars every year as opposed to the whole nut in one shot. So that's the stretch rule. Now, under the Secure Act, that largely went away. There's still some people who can do that, and I'll explain who those people are. But if you inherit, if someone dies after 2019, so any point from January 1st of this year forward, if someone dies and leaves a tax-deferred account, the person who inherits it generally has to completely withdraw all the funds from that account within 10 years. Specifically, it's 10 years starting with the year after the year of death. So if someone were to die this year and leave you an account, you have up until the end of 2030 to completely empty that account out. Now, there's no required minimum distributions per se. You can take out as much or as little as you want along the way, but it needs to be emptied by the end of that, that 10th year. So you can't stretch it anymore. Going back to the example before, if you're 40 years old and inherit this account, you have to empty it by the time you're 50, basically. Again, as little or as much as you want along the way, but it needs to be completely empty by the end of that 10th year. There are some people who can still stretch. There's I think it's 5. A spouse. If you inherit a tax-deferred account from your spouse, you can either make it your own, like literally just roll it into your own IRA and then play by the rules as if it's always been your own IRA. Or you can do the stretch depending, based on your remaining life expectancy. You can take these minimum payments based on this stretch rule that you're still allowed to do. Other people who can stretch are those that are chronically ill, and I think chronically disabled as well. Um, Minor children, but only if your child is what's called under the age of majority. Now that differs state by state. In some states it's 18, some's 21, some states it could be somewhere in between. So if you die and leave your tax deferred account to your minor child, that child can stretch it based on his or her age at the time they inherit it. So whether they're 10, 12, 15, whatever. But once they hit age of majority in your state, and again, I think that's between 18 and 21, depending what state you're in, then the 10-year kicks in and they need to dump it, empty it within 10 years of that, I think. I'm not 100% certain, but I believe that's how the 10-year works. It's 10 years from when your child hits the age of majority. The other one is if the person inheriting it is no more than 10 years younger than you. So, for example, you leave it to your cousin and your cousin's only 4 years younger than you. Your cousin can still stretch out his or her distributions from your inherited account over his or her, remaining life expectancy. So those are it. I think that was 5 I hit on. Those 5 people can still stretch. Everyone else needs to take it out in no more than 10 years. Now, in some cases, it's even worse. This is getting a little too technical, but like if you leave it to an entity, so a business or something, they only have 5 years to empty it out, not 10. But we'll leave it there for now. All right, quick check of comments. Tim Mansour, can I get continuing education for this? That'd be a good idea, actually. I don't know what I need to do to get approved for that, but it sounds more formal than I want to make these, but that would be nice. I'll sign off on it at least. Give me something and I'll sign it. All right. And just for the fun of it, everyone, Tim Mansour, a friend of mine from high school. So he's, I'm sure he's joking around. He's jesting here. I know him well, and I know his humor. So no, Tim, unfortunately, no continuing education, but it would be cool if we could, I guess. All right, so those are tax-deferred accounts. Next, we'll talk about Roth accounts. Again, Roth is still a form of qualified account. The difference is, unlike tax-deferred, Roth is the opposite. You do not get a deduction when you put money in, and the money grows and comes out tax-free in most cases. If you are the beneficiary to an inherited Roth IRA, generally speaking, that is all completely non-taxable to you when you take the money out. You still need to empty it within 10 years, just like with regular IRA, like we just talked about. You still need to empty that account within 10 years, starting with the year after the year of death. But there's usually not going to be any tax on any of those distributions to you, the beneficiary who inherited it. The only time there may be, again, getting a little more technical than I wanted to, is if the decedent, the original owner of that Roth IRA, did not meet the 5-year rule, we'll just simplify it and say did not have the account for at least 5 years. In that case, when you inherit it, you pick up on that person's 5-year clock. So let's say the person who died had the account for 3 years. You can't take out earnings tax-free until 5 years have been met. So you inherit it, the original person owned it 3 years. You would need to hold that account 2 more years before you can withdraw the gains from that account tax-free. You can always withdraw the contributions the decedent, the person who passed, put into the account, but you may need to wait no more than 5 years to take those gains out tax-free. So again, a little more complicated than I want to get into, but just know that receiving an inherited Roth IRA isn't always completely tax-free. There may still be a case where you would owe some tax just on the earnings though, so not that huge of a deal, thankfully. All right. Okay, question about the volume. Yeah, trying to speak loud. I got a quasi-collared shirt here, maybe somewhat dampening the sound between my mouth, my gullet, and this microphone here. All right, question. Tim Mansour, can you convert to Roth in the 10-year period? No, great question. So, Tim, I assume you're referring to if you inherit a traditional IRA from someone, can you convert it to a Roth IRA? No. And here's why. Sounds funky, but this is how it is. When you inherit a 401k or an IRA from someone, it doesn't become your account. It's still technically the account of the person who died. You are just merely the recipient of the income from that account at this point. It's not your account. Because it's not your account, you can't roll it into your Roth IRA, Tim. Great question, though. Here's one exception. Roth traditional 401ks, when you inherit it, can be rolled into your Roth IRA. I don't know why that's allowed, but you can do that for 401ks. For IRAs, no, you cannot inherit an IRA and then roll it into your Roth IRA. The exception is for spouses. Again, if you're a spouse and you inherit an IRA or 401k, you can truly, in every sense of the word, just throw it into your own account as if it's always been yours. At that point, yes, you can then convert it to your Roth IRA. But anyone other than a spouse, you cannot inherit an IRA and convert it into your Roth IRA. Good question. All right, so that was Roths, inheriting Roths. Let's just see what else we got here. Good, yeah, all right. So Cody responded same thing. Yep, good, thanks. All right, next type of account, what do we got here? Regular brokerage accounts, which I'll call non-qualified accounts. So, account you open their own stocks, bonds, mutual funds, exchange traded funds, what have you. It doesn't matter. This is quite different than the tax, tax deferred or qualified world. So let's say someone has a brokerage account with $1 million worth of stuff, stocks, bonds, whatever. They originally bought that stuff for only 200 grand. So there's $800,000 of gains that have since built up in that person's account. That person dies when that account's valued at $1 million. They leave it to you. You inherit that $1 million tax-free. There's no tax to you as the beneficiary receiving it. And what happens now is you have all these assets that had $800,000 worth of gain that the original account owner would have had to have paid tax on had he or she sold those positions while they were still alive. But there's something called the step up in basis. And hot topic lately, and I'll explain what I mean. But when that person dies, the basis is IRS speak for the cost or price you paid for something, the price you bought it at. So in our example, $200,000 was the basis. That's the price paid for that portfolio. It since grew to $1 million. When you inherit that account, you inherit it as if you bought it all for $1 million. The basis got stepped up from the 200 that it was in the hands of the original owner, stepped up to $1 million, which is the valuation on that person's date of death. You inherit that account as if you paid $1 million for it all. So now you have $1 million worth of assets, no tax on it. The $800 of unrealized gain that there was magically goes away. No one's taxed on it. On the difference above and beyond $1 million. So again, you inherited them when they were worth $1 million. You sell it 6 months later for $1.1 million. You only have to pay tax on that $100,000 gain. Make sense? Because the basis stepped up from $200,000 to $1 million. Here's the other cool thing. I'm sure you all know about long-term versus short-term capital gain. So you buy a stock today, you sell it in 2 months, it's a short-term capital gain. You have to pay regular ordinary income tax on that gain. If you instead held that stock more than 12 months before you sold it, that gain is then what's called a long-term capital gain, and it's taxed at a lower rate. When you inherit these non-qualified assets from someone, you can turn around and sell them tomorrow. You don't have to wait a year. Whenever you sell them, any gains will be taxed at the lower long-term capital gain rate. You do not need to wait a year after inheriting the assets to sell them for the long-term capital gain. That's a nice little, I won't call it trick. I mean, it's not trick, it's just a fact of the tax code, but it is beneficial and something to know. So when you inherit assets, you can sell them immediately if you want to, and any gains you have will be the favorable lower long-term capital gains tax rate. It will not be the ordinary income tax rate. Make sense? All right, let's take a look at some questions here. Lori Nagel asks, if you are disabled, you don't have to take an inherited IRA in the 10 years, question mark. Yes, that's correct. Is it life expectancy? Yes. So, Lori, yes, you can still do what's called the stretch provision, which basically you look at your age, the year you inherit it, and there's IRS tables that say, okay, you're 40 years old. Like I said, I think it was 43.6. I want to say is the remaining life expectancy. So you can stretch out your distributions over the course of the 43.6 years if you are disabled, because disabled, chronically ill, again, minor children and inheritors that are less than 10 years younger than you, they can all still stretch based on their remaining life expectancy. They're not forced to take it out within 10 years. Good question, Lori. And again, this was all as a result of the Secure Act, which went into effect January 1st of this year, 2020. Patty Fairchild, if several non-spouse beneficiaries, how should bequest be titled, and how should they title accounts when inherited to get the best tax treatment? Yes, great question, Patty. Hold that thought. I'm gonna wait till the end. So initially now I'm just talking about like what happens when you inherit, and the second part of this presentation will be how to structure and plan things in setting up your estates and beneficiaries to take best advantage of all this. But good question, Patty. Aaron, you kind of can inherited to Roth. I have the situation. I have an inherited traditional from my dad. I take my RMD. It makes a pit stop in my taxable account, and then from there I move it to my Roth. Be careful with your words, Aaron. Not to be nitpicky about it, but you're not actually converting. And I say you're saying this. You're saying you're kind of converting. You're making straight up contributions, and anybody who has earned income, but not too much earned income because you phase out at a certain level, can make a contribution to a Roth IRA. That's all you're doing. It doesn't matter where you get the money from, whether it's from cutting grass or you got it inherited or whatever. So long as you have earned income and it's not above like 200 grand if you're married or lower if you're single, yes, you can make contributions. So you're not technically converting anything, Aaron. You're just taking money from here and mixing it into your checking account with your wages and whatever else, and then separately making Roth contributions. To Mansoor, what if the original owner paid more than what it was worth when he or she died? Don't matter. The loss, so I guess let's go back to another example. So the person originally paid $200,000 for this pot of assets in a regular brokerage account, and instead of it growing to $1 million as of when they died, let's assume it dropped to $150,000. So there's a $50,000 loss. Pretty sure that loss, no one gets the benefit of it. I could be wrong. I'm not 100% on this. But I think it's just $150,000 is what it is. That then is the basis that moves over to the person who inherits it. And that's that. Just like the gain magically went away when that person died due to step up in basis, I think the loss, not so magically, doesn't get utilized by the decedent, by the person who died. Now, I can be wrong, Tim. You may know more than me. I know you're thick into the more complex stuff about taxes. I don't know, if you do a lot of estate returns and things, but I believe that loss just gets lost, and the 150 grand will be the basis that the beneficiary receives. So when he or she sells it, the gains are keyed off of that price of 150. Or if there's losses, they sell at a loss, then they can realize that loss at that point. But I don't think I think the loss gets lost in the hands of the decedent and just kind of disappears upon the estate transfer process. Okay. Darren, can my kids convert my 457 to a Roth after I pass? I know you said 401k could. Ooh, that's a good one. I don't know. I don't know if 401k specifically can, or if it's employer retirement plans in general. Now, 457, I'm just thinking out loud. I don't think 457 is technically a retirement plan. I think it's like a deferred compensation plan in structure. So I don't know the answer, Darren. Have to look it up. I don't think so. I think this magic conversion ability may just be for 401ks in particular. If anyone else knows, please share. But my guess is probably not, Darren, but I can't say that with certainty. All right, Robin McNaughton, is it advisable to title taxable accounts as POD, TOD? Yep, another great question. Hold on, I will definitely get to that at the end. All right, so that's excuse me, non-taxable accounts like brokerage accounts. We talked about the step up in basis. Now, why I said that's a hot topic is not making this political, just stating what we know currently. It was is one of Biden's main tenets of his proposed tax changes he'd like to do is to, I don't know if it's completely get rid of step up in basis or reduce it, or have it only, I think the intention was have it only removed for people over a certain income level or something along those lines. The details are all still to be hashed out, and who knows if and when it'll ever actually make its way to legislation. But nonetheless, it's worth having on your radars that this step up in basis thing, the idea that this unrealized gain magically goes away when someone dies, that's potentially on the chopping block. That's all we know for now. Again, don't get ahead of yourselves. Don't assume it's done. Who knows if and when it'll happen and what will look like if it does happen. But just know that step up in basis could potentially go away, or at least change to some extent. Maybe in the next handful of years, but we'll see. Way too premature to consider anything a done deal. All right, next. So Darren's saying, yes, 457 is a deferred comp plan. So yeah, I'd be pretty confident in saying, no, you can't convert that as an inheritor, as a beneficiary. But again, don't quote me because I'm not sure, Darren. HSAs, health savings accounts. So HSAs are one of the best accounts out there, in that they're triple tax advantaged. So whereas like a tax deferred account saves you tax up front, but you pay for it on the back end, a Roth is the opposite. In a Roth, you pay tax up front, but it's tax free on the back end. An HSA is the best of both worlds. An HSA, no tax up front, no tax on the back end, and no tax along the way. Even better, if you have an HSA through your employer, chances are, not all cases, but chances are, your contributions to your HSA that you make through your employer will also not only save you income tax, but will save you the payroll taxes, meaning Social Security and Medicare tax will not have to be paid on the amount of HSA contributions you make through your employer, in most cases. All right, so anyway, so the point is HSA is super tax advantaged, great vehicle to have. One of the best retirement savings vehicles there are, because you can let it sit and have it invested. You're allowed to invest HSAs in whatever you want or whatever the custodian allows, but a lot of them have, a wide array of things you can invest in. You can feasibly build up an HSA over decades, get some really good long-term growth. Again, tax-free on the way in, tax-free on the way out, grows tax-free, and use it to pay for medical expenses in retirement, like Medicare premiums, out-of-pocket costs, dental expenses, vision expenses, whatever. So anyway, great type of account to have, but not a great type of account to leave to someone. When you die, if your spouse inherits your HSA, he or she still gets to use the tax-free awesomeness of it, and that, withdrawals to pay for qualified medical expenses will still be tax-free in your spouse's hands. If you leave it to anyone else, that favorable tax treatment goes away. The HSA then comes completely taxable. Every dollar taken out is taxed as ordinary income to the beneficiary. And even worse, it all needs to be taken out. I don't know if it's in the year of death or within a year of death or by the end of the year after death, one of those three. But the point is, you don't have this 10 years to take it out. You definitely can't stretch it over your lifetime. It needs to come out relatively quick. Let's just assume a year, give or take. I don't know the specifics, I forgot. So if you leave an HSA, 50 grand in an HSA, you leave it to your child, that's not a good thing to leave to a child, because they're going to have to pay tax on all of it and take it out, within about a year. So if they're in their high earning years, they're already paying a lot of tax, you now dump on them the requirement to withdraw this 50 grand of taxable income on top of the income they already have. That's not ideal. So if you have an HSA, or you can leave it to a charity. If you're charitably inclined and you want to, your plan is to leave some of your assets to charity, HSAs are good to leave to charities. So are regular tax deferred accounts, because charities don't pay tax. So whereas these accounts will be taxable in other people's hands, they can come out tax-free in the hands of a charity. So anyway, HSA, okay to leave to a spouse, generally not good to leave to anybody else unless it's a charity, because charity won't have to pay tax on it. Okay, that's HSAs. And finally, non-investment account things, cash, houses, cars, jewelry, other random property, tools, whatever. I have a lot of woodworking tools, that's going to go to someone at some point. How are those taxed? Basically, there isn't any tax. So someone leaves you $500,000 in a savings account, boom, that's yours, tax-free. Comes out, do as you please with it. If you then invest it or you put it in your savings account, it starts earning interest, you then have to pay tax on the interest or the gains or whatever from the point where you inherit it onward. But upon the act of inheriting it, zero tax, whether it's 20 bucks or 20 million bucks, no tax to you inheriting cash. Houses are the same thing. Well, sort of. So houses are kind of like a regular brokerage account. Whatever the value of the property was on the date of death, the basis is stepped up to that. So let's assume someone bought a house for 500 grand. It was worth $1 million when they died. You inherit it. That house, now you get something worth $1 million. Your basis or cost is assumed to be $1 million. If and when you sell it, you're only potentially taxed on the gain above and beyond that $1 million. Then other things, jewelry, cars, whatever, you just simply inherit them at their current value. No tax, you don't have to pay tax on it. Just like cash, basically, you get it, whatever it's worth, it's worth. It's now yours, so do with as you please. So that's the catch-all for everything else. All right, I'll leave it at that. So that's those are the main types I came up with. There may be other things. Oh, businesses. Inheriting a business. That's outside my world. I don't know. Business planning and business taxation is a whole different animal. It's something I choose to not get involved in much, if at all. I know the basics, but even professionally, I don't work with people who have substantial business assets. It's just a whole different layer of complexity that I'm interested in taking on. So I don't know much about inheriting a business. Someone asked that in the group before. What happens with the machines the business owns and the depreciation, stuff like that. I don't know, to be honest. That's outside of my scope of interest and expertise. So I can't speak to that. But otherwise, I think I covered all the other major types of assets that one could inherit and how they'd be taxed. So let me get a little drink here, check some questions. Alrighty. Mavis. Andy, you mentioned that you can't convert an inherited IRA to a Roth, but assuming you have earned income, can you just contribute to a non-deductible IRA, then convert it little by little? Yes, Mavis, you can. And that's what, who was it? Was it Robin? So Erin was saying before. She said you can kind of convert it. And that's why I said be careful with the words you're using, because you're not converting. You're just simply, Mavis and Erin, you're just simply making contributions. Whether you're in an income tax bracket that you can make direct contributions to a Roth, whether you're in an income tax threshold where you can directly contribute to a Roth, or you do it by way of the proverbial back door, which is what Mavis is talking about here. Mavis, in your case, you're just making a contribution to a regular IRA, then turning around and converting that to a Roth. Anyone could do that anyway, assuming you have earned income, which you rightfully pointed out. It doesn't matter that you got an inheritance or didn't get an inheritance. You can still do that just the same, Mavis. So yes, you can get inherited money, commingle it into your checking account with your wages and whatever else, and then go separately make contributions and convert them. Yes, but there's no direct tie-in. Like, you can still do that regardless whether or not you got the inheritance. So in my mind, like, don't mix these two things together, because they're unrelated things. Mavis and Erin, for that matter. But yeah, good comment. You can still do what you're talking about, Mavis, but it has nothing to do with the inheritance technically. All right, so Cody, clarifying the HSA thing. Yes, the account value of your HSA becomes taxable to your children in the year of your death. Okay, so yeah, I guess if you die at some point in 2020, you leave your HSA to anyone other than your spouse, it's taxable income in that year, not the year after or not a year from, but sounds like in that year. So thank you, Cody. Jackie says, or leave the HSA to multiple beneficiaries so the tax impact won't be as great. Yes, good point. I'll touch on that at the end about how to structure beneficiaries. Karen, does a will with named inheritors trump named beneficiaries? No, it doesn't. So, right, it doesn't. Not for, good question, Karen. I'll get to that now, actually. So there's certain assets that pass by contract or by beneficiary form, or however you choose to call it. For example, retirement accounts, IRAs, 401ks, 403bs, Roth IRAs, Roth 401ks. Those things do not pass by your will, and you don't want them to pass through your will. They already have a mechanism built in, which is the beneficiary form. So whenever you open any one of those accounts, definitely name your beneficiaries directly on that account. That will override your will. Doesn't matter what your will says. When you eventually go, your the custodian that holds the account and or the executor or executrix of your estate will look at your account, see who the beneficiaries are. That's where that money goes to. Doesn't matter what the will says. So that's one type, retirement accounts, qualified accounts. Insurance assets also pass by contract. So for example, life insurance, right? You name who you want your policy to pay out to in the event of your death. Doesn't matter what your will says. When you die, your policy dictates where that money goes, even if your will says something else. Now, in the event you don't name someone, you don't name beneficiaries in your retirement accounts, you don't name a beneficiary in your life insurance, then yes, then I think it defers to your will. And then it's the probate judge who's overseeing it will decide where he or she wants it to go, how that jives with what he or she thought your intentions were in the will. So things get messy that way because it comes down to judge discretion to some extent. So if and when you have the ability to directly name beneficiaries, again, retirement assets, insurance, definitely do it. Keep them out of your will altogether. Good question, Karen. John McLaughlin. Okay, so what is the maximum that can be inherited without tax? 20 million? Great question. So this one's complicated, but it's interesting. And then I see Frank Campbell responded back with 11.58 million. So a lot of you have probably heard of the estate tax exemption. First of all, what is estate tax? When you die, your estate is simply the value of everything you owned up until your death. All the stuff you owned then becomes your estate. If the value of your estate is over a certain level, you have to pay estate tax. Federally, it's 40%, I think, on the amount over that threshold, that exemption level. Different states may also have their own estate tax above and beyond, in addition to the federal estate tax. Now, not all states have estate tax. Some do. I had a post I made a post in the group a handful of months ago called Death Taxes. It was from taxfoundation.org, I think. It showed which states have estate taxes or inheritance tax. So there are cases where your estate may need to pay tax if it's larger than a certain amount. Currently, the federal estate tax exemption is 11.58 million in 2020. Meaning if you die and you have less than $11.58 million worth of stuff that's going to your estate, you will not owe any federal estate tax. You may owe state estate tax, depending what state you're in and what its exemption threshold is. Every state can have its own different thresholds, which is annoying, but you may owe state estate tax, but you won't owe federal estate tax. Now here's where things get complicated. Yes, Cody just shared that estate tax link. Thank you, Cody. So here's where things get complicated, and that 11.58 million won't necessarily be 11.58 million. You have to also factor in how much money you gifted in your lifetime. So that 11.58 million is technically called the unified credit. If you don't make any sizable gifts during your lifetime, then yes, you can die with up to $11.58 million in your estate in 2020, and your estate will not owe any estate tax on it. But if during your lifetime you made any gifts larger than the annual gift exclusion, and what do I mean by that? So 2020, for example, you can give away 15 grand to any person you want. You can give them cash. You can just walk out the street, boom, 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 boom. 15,000 bucks to anyone you see. You do not need to report it. They don't need to report it. No one pays tax on it. No one even knows about it. Completely legit, legal, whatever. That's the gift tax exclusion. If, on the other hand, you give away more than $15,000 this year to anybody, whether you give a house to your child and that house is worth 300 grand, whether you give 50,000 bucks cash to a cousin or whatever, if the value of the gift exceeds 15 grand, you need to account for that difference that difference will chisel away at your 11.58 million unified credit. So let's work through an example. So let's assume you give away your house to your child. You own your house free and clear. It's currently worth $580,000. You just flat out give it to your child. You can do that. You're allowed to do that. You don't pay tax on the gift. Your child doesn't pay tax on receiving the gift. But because it's over $15,000, you need to file a gift tax return, and you're basically notifying the IRS, say, hey IRS, I gave away something worth $580,000 to this person this year. The IRS then says, okay, fine, but that 580 grand you gave away will now chisel away at your $11.58 million estate tax exemption. So now you can only die with $11 million because you gave away the 0.58 already. You gifted that much. You can now only die with $11 million. Any money you have above and beyond that, your estate will have to pay tax, estate tax. Extreme example, let's assume this year you gave away $15 million cash. Be nice to have that much, but whatever. You gave away 15 million bucks to whoever, it doesn't matter. You used up your entire $11.58 million estate tax, unified credit, which basically means if and when you die, you have no more estate exemption left. Every single dollar you die with will all be subject to estate tax at that point. Does that make sense, hopefully? I know I got off on a tangent, and that's kind of technical, but point is that $11.58 million estate tax exemption may not actually be 11.58 if you've given away substantial amounts of money during your lifetime. I'll leave it there. All right, but yes, good question, John, and good reply, Frank Campbell. Beth asked, did I speak about inheriting an annuity? No, I did not. Let me think about that. So an annuity is an insurance product. So in essence, you're inheriting an insurance product. Now, it depends. Annuities get complicated, Beth, but let's just assume that the death benefit associated with the annuity you're thinking of is just a flat out payment to someone, a la regular insurance. In that case, no, I don't think there's any tax implications to anyone. It's just as if someone died and the person received life insurance. An interesting fun fact, insurance proceeds are completely not taxed. So if you have a $50 million insurance policy and you die tomorrow, whoever receives that 50 million bucks, completely tax-free to them, which is awesome. So insurance is a tremendously valuable way to basically transfer wealth tax efficiently upon your death, because insurance proceeds are completely tax-free. With that said, an annuities have different ways they can pay something out upon your death, upon the annuitant's death. If it's just a straight up like life insurance, like lump sum death settlement, Beth, then no, I don't think it's taxable at all. If, on the other hand, the death feature is that someone else steps in as the annuitant to receive payments, then yes, there's going to be some sort of tax implications. It's not going to be fully taxable, I don't think. Annuity taxation gets fairly hairy depending how the annuity is structured, but assume there may be some tax in that case, Beth, if someone's continuing on receiving payments. But if it's just a flat lump sum death benefit, I don't think there's going to be any tax on that, but don't quote me. Jackie's saying that the estate tax exemption is increased to 11.7 million next year. Super cool. All right. Just scanning over the other comments here. All right, good. Looks like we're caught up. Okay. Next, so that's how assets are taxed when they're inherited. With that in mind, how and why could you or should you structure your estate plan / tax plans? Now, again, this is where I'm not an estate planning attorney, and some of this will depend state by state. So don't quote me on any of this. But here's kind of the rules of thumb for who to leave assets to and why. Let's start with the regular tax-deferred assets. Traditional IRAs, 401ks, 403bs, TSP, 457. Again, those will all be regular, ordinary taxable income in the hands of the beneficiary. If you leave them to a spouse, your spouse can make it his or her own, and they can just fold it into their accounts. Could be good, could be bad. If your spouse needs the money, then sure. If your spouse already has a lot of money and you're just like dumping more on him or her when you die, that may not be ideal because you're now putting a bigger tax burden on them. So maybe then you want to instead consider naming some other beneficiaries, whether it's children or relatives or whatever. The thing to keep in mind is, like I said, this is all going to be regular, ordinary taxable income in the hands of the beneficiary. So let's assume you have children who are in their 40s, they're in their peak earning years, making good money, potentially already in high tax brackets, 35, maybe 37% federally. And chances are they're going to continue earning a lot, for the rest of their career. It wouldn't be ideal to leave them a traditional IRA because they're going to have to take it out in 10 years and they're going to have to pay tax on it. So you're now like sticking them with more taxable income. A good problem to have. I mean, it's money they didn't have in the first place, so cry me a river. But if you have other options of where to leave that money, like if there's, think about it this way. Let's say you have a traditional tax-deferred IRA and a Roth IRA that you're going to be leaving to someone, and you have two kids. One's very financially well off, one's struggling. It would be better, all else equal, to leave the Roth IRA to the higher earning kid because that child already has high tax bracket because of their wages. So you don't want to, pile them on with more taxable income. Leave them the Roth because that will be tax-free to them, and leave the tax-deferred account to the financially less well-off child because that child is at a lower tax bracket. Therefore, the tax bite taken out of that account will be smaller in that person's hands than the higher earnings person's hands. Does that make sense? Hopefully. Now, maybe you don't care. It's like, whatever, this is too much work. They'll get what they get and they'll be happy with it. Then fine. But if your concern is really like maximizing the after-tax amount of inheritance that these people get, then you definitely do want to consider, are they high earners or whatever? If so, don't leave them with more taxable income if you can avoid it. Charities, it'd be okay to leave tax-deferred accounts to charities. So for example, if one of your legacy goals is your alma mater or your church or whatever, you want to leave them 200 grand. All else equal, it would be best to leave them 200 grand of tax deferred money like an IRA. If you have two accounts, you have 200 grand of a Roth left and 200 grand of a tax deferred account left. It'd be better to leave them the tax deferred account because it will not be taxable in their hands because they're a charity. Don't waste the tax savings by leaving the Roth to the charity instead because they're not going to be taxed anyway. You want to leave the tax deferred money to the charity because then the only person who loses out is Uncle Sam because the charity doesn't pay tax. The beneficiary won't be taxed because you're going to leave the Roth to your other non-charity beneficiary. Cool? Good. Trusts. This comes up a lot. Now, I'm not a legal expert, and this could all depend state by state, but generally speaking, with tax-deferred accounts, traditional IRAs, 401ks, 403bs, what have you, do not name trusts as the beneficiaries of those accounts. Rewind. Do not name trusts as the beneficiaries of those accounts. Why do I say that? So I haven't seen this play out firsthand, but I've anecdotally heard and read lots of horror stories. Trusts are not individuals. They're not people. Like individuals have fairly large tax brackets. So for example, a single taxpayer, your first 10 grand is taxed at 10%, your next 30 grand is taxed at 12%, your next 45 grand is taxed at 22%. If you're a trust is its own legal entity. Trusts, once they have over I think it's like $13,000 of income, they're taxed at 37%. So remember, tax deferred accounts are not assets. They're just they're not yet taxed income. So if you leave $1 million IRA to a trust and the trust has to be the one to distribute and realize that income, guess what? The trust is paying 37% tax on basically all 1 million of those dollars, potentially. That'd be bad. So you don't want the trust to have to pay tax on it and then pass out what's left to the beneficiaries. You want that account to go straight to the beneficiaries, skip the trust, skip the risk that the trust has to pay tax on it at 37%. Get rid of that altogether. Just leave the trust out of it completely. Again, tax deferred accounts passed by beneficiary form, not by will. So don't bother with that nonsense. Just name the beneficiaries directly on that account's beneficiary forms. Do not name a trust as the beneficiary of that. Now, this won't always be a problem. There are certain types of trusts called see-through or conduit trusts where the way they're structured and worded and how they're created, the trust isn't the entity that pays tax. The trust is just a conduit that takes the IRA distributions and passes them through to the beneficiaries. So it is possible you can have a trust as a beneficiary of a tax-deferred account and it will not blow up in your face. But to avoid any possible risks or something going wrong or this trust being improperly structured and not actually being a see-through, pass-through, conduit trust, whatever, just avoid it. Don't name a trust as the beneficiary of a tax-deferred account. There's some exceptions. Special needs trusts. Now, just like I don't get involved in business planning, I admittedly don't know much, if anything, about special needs planning. That's a whole different area of specialization within financial and tax planning and estate planning. But there's times where the benefit of having the money in a trust and having it shielded from government services taking it away from, from the special needs recipient, cases like that where even if you have to pay the tax hit, the ability to shield the money in the trust away from the hands of government services is more valuable to you than having to pay a tax. So there are cases where leaving your tax deferred accounts to a trust could make sense. Again, special needs trust is one of them, but I'm not an expert, so I'm going to leave it there. Or if you have kids that have substance abuse issues or have lots of lawsuits or are facing bankruptcy or something like that, and you want or need to keep the money shielded and protected from those creditors, then maybe a trust still makes sense. But otherwise, in most circumstances, leave a trust off your beneficiary forms. Just name the ultimate beneficiaries directly. Right. Okay. Let's see if that generated any comments here about trusts. Yeah, not trust related, but Doug Yachty has had a good point/comment. So from a tax perspective, when you have a tax deferred account, you can name a primary beneficiary, which is, the person who is first in line to receive it. You can name a secondary or contingent beneficiary, meaning if that person is already dead, the primary is dead, then it goes down to the contingent beneficiaries. A primary beneficiary can consciously elect to not take the inheritance. They can say, I don't want it, don't need it, skip me, just pass it down the chain, go to whoever the next beneficiary in line is. So that's one way that, if that primary beneficiary already has a lot of wealth, is already earning high income, he or she may be like, I don't need it, I'm just going to pay a lot of tax on it, don't bother, let me pass it down to the next person. So if that person is a lower earner, has less assets, whatever, more in need of the money, you can do that. A person could call disclaim. A beneficiary can disclaim his or her stake to inheriting that asset and just pass it on to the next person. That's another way people can sort of consciously avoid having to pay tax or, let someone else pay tax if that someone else is in a lower tax bracket or something like that. So thank you for that, Doug. And someone else brought that up as well about disclaiming. Or naming multiple beneficiaries where one can simply step out and be like, I don't want it, don't need it. Let my other two siblings take my share of it so I can disclaim what would otherwise be my inheritance. And can you leave money to grandchildren since they will likely be young and won't have any earnings? Sort of. There's generation skipping tax. Let me think about this before I say something wrong. I'm drawing a blank. I'm confusing things in my head. And there's something called generation skipping tax. I don't know if it comes into play with inherited assets or if it's only gifting. It might just be gifting. I don't know. I'd have to get back to you, Anwisha. Yes, you can, like a grandparent can leave an inherited account to a child. I don't think there's anything wrong with that. I don't think there's any additional taxes on that. Other than the, here's where things could get complicated. There's something called the kiddie tax, where children who have lots of unearned income, they pay higher tax rates than adults otherwise would. So it may not be ideal to just, if you're a grandparent, to leave all of your tax deferred assets to a grandchild. But I'm forgetting the specifics, so don't. You definitely discuss this with estate planning person or something, and we should, if this is one of your questions or concerns in your life. But there are some angles to consider with leaving money to grandchildren. Yeah, I'll stop there. Patrick's saying he got hit with Iowa estate tax. Yep. Wasn't fun to pay. Of course not. Yeah, not cool. All right. Mavis, on brand. Andy even thinks of TERP through the generations. Yes, I do. TERP is forever, like Wu-Tang. Ned, if I designate my disabled daughter as beneficiary for a 401k and she has been receiving Medicare benefits, will the government go after her inherited money? If so, can I protect it for her by leaving it to the special needs trust? Yeah, and this is where I don't know, Ned. I'm ahead of my skis on this. I fully acknowledge I don't know enough about special needs planning. But my understanding is that, yes, if you leave any of your assets, including your 401k, straight away to your daughter in name, I do think that then becomes her assets that the government can take. Instead of the government paying for whatever services that they're giving her, they'll be like, oh, wow, she's got $2 million now. Well, guess what? We're taking that. She's going to have to spend that down before we start footing the bill again. So special needs trust is the way that you can do that. You can, again, I'm not an expert. I'm just saying what I think I know, but I'm acknowledging this isn't my area of expertise. Definitely work with a qualified estate planning attorney and a special needs focused attorney and financial planner. But I do think you're able to leave your 401k to a special needs trust. That trust then isn't technically your daughter's money, so the government can't come after it. The trust can be set up so it could dribble out little bits of money to her to pay for personal expenses or some level of care, but it won't be that the government can seize all of it and take it, because it's not actually her money, it's the trust money. Now, this is the downside. I think that because you'd be leaving it to a trust, the trust would be the one paying the taxes on it. And again, that tax rate's going to functionally be 37% on basically all of your money in that 401k. That's the downside. But the upside is it provides you the ability to shield the assets so the government can't come take it. That's all I know. And again, I don't even know that that's completely accurate. So definitely, Ned, run those questions by someone who does specialize in special needs planning, because that person's not me, unfortunately. Okay, right. So POD, TOD. I think Kathy asked this before. Speaking of beneficiaries, so as I mentioned, tax deferred accounts and life insurance contracts, you can name specific beneficiaries. It's part of the account. Non-qualified assets, checking accounts, savings accounts, regular brokerage accounts. You can functionally name a beneficiary by adding something called a TOD or POD, which stands for transfer on death or payable on death. It's a letter, it's an agreement, it's a form you sign up with that institution and say, hey, upon my death, transfer this account to my spouse or to my kid or whoever. So that if and when you die, that account doesn't have to run through the court probate process, which could potentially take months. The checking account, the bank institution or whatever can say, oh, this person died. He designated, Jane Smith as the transfer on death recipient. So now we're going to give this account to Jane Smith. So it is a way to expedite the estate transfer process by having a POD or TOD designation on, again, non-qualified assets, checking, savings, regular brokerage account. So Kathy's asking, is it okay to name a trust as a beneficiary of bank accounts to avoid taxes? Interesting. There's two questions there. Yes, it's okay to name a trust as the POD or TOD of those regular accounts, that's practically no different than just having your trust own those things anyway. Like lots of people start living trusts, revocable living trusts, and they put their house in it, they put their checking accounts in it, they put their brokerage accounts in it. So doing that by way of POD or TOD gets you to the same spot basically, but you don't avoid taxes, Kathy. This is where trust gets complicated. Depending on the type of trust, you wouldn't avoid any taxes. It's still taxable to you while you own it, and when you die, these accounts that you have POD or TOD still get lumped into your estate nonetheless, and will still be subject to your estate tax, 11.58 million exemption threshold, Kathy. Hopefully that answered your question. All right. Okay, a couple more. A couple more comments. There's a few more comments. We'll just run through my last few points. Wow, it's 9 o'clock already. Time flies when you're talking about inheritance. Other things. So Roth assets, those are good to leave to anyone because nobody pays tax on it. But again, if you have a Roth account and a tax deferred account, pay attention to what goes where. Like if you're leaving money to charity, you ideally want to leave them tax deferred stuff because then no one ever pays tax on that money. Don't leave a Roth to a charity if you have an option, if you can instead leave them tax deferred things. So Roths are good to leave to people who, anyone else basically, because they're not going to have to pay tax on it. Non-qualified brokerage accounts, regular brokerage accounts. Again, basically good to leave to anybody because of the step up in basis, which may be going away or changing at some point possibly. But for now, the step up in basis concept means whoever you leave it to, he, she, or they, there's no tax upon the receipt of getting that inheritance. They may have to pay tax if and when they sell stuff at gains, but otherwise it's fine to leave them the assets because they don't pay tax upon receiving it. Charity, same story. If you want to leave money to charity, this isn't a bad thing to leave because you can just simply, the stocks, the bonds, the funds go to the charity. They don't pay tax on it. Everybody's happy except the IRS. They're the ones who get, skipped out on taxes. Health savings accounts we already talked about. Fine to leave to a spouse, fine to leave to a charity, far from ideal to leave to anybody else because the tax-free magic then goes away. It becomes completely taxable to whoever receives it, and that person needs to fully distribute in the year of death. So that can be more tax than necessary for the beneficiary of the HSA. Physical property, cars, houses, my table saw sitting in my garage. Not ideal to leave to charity in most cases because charity's probably not going to know what to do with it. Now there are places like, I don't know if this is national or just here, but like 1-800 Cars for Kids or whatever it is. They advertise, they'll take cars as charitable donations that they then use, they monetize, they sell it or whatever, and then use the cash to go help whatever kid-related charities that they support. But like if you're leaving stuff to your church or to some other small charity, like they're not going to want your house. Like it's going to be too much hassle, is my guess, for them to try to sell it and whatever. They're going to want cash. So point is, house, cars, other physical, tangible property like this desk, probably not ideal to leave it to a charity just because they're not going to know what to do with it. And your kids may not either. Like this happens all the time. Kids inherit a garage and an attic full of decades worth of stuff from their parents. And it's like, ugh, now, what am I going to do with all this stuff? Think about a charity kind of the same way. Someone's got to do something with it to get the value of it. So, all right, beneficiary naming. Let's see, did we hit on the stuff here? Right, so tax deferred accounts, insurance accounts, definitely make sure to name the beneficiaries there. Don't have those run through your will. It's adding unnecessary steps and delay, complexity with your estate transfer. Just name the beneficiaries directly. Non-qualified accounts, checking, savings, regular brokerage, good practice to add the POD or TOD, which again stands for payable on death or transfer on death. It's a way to basically add beneficiaries to those accounts to help expedite the estate administration process. And things like houses. If you're married, you can own your home jointly with your spouse. So that, and this is going to depend state by state. Some states have community property laws. Some states allow different types of home ownership. There's like joint tenants with rights of survivorship. There's tenants in common. There's tenants by the entirety. So you don't even need to be married to have some of these, but for some you do. anyway, depending what state you live in, you can own homes jointly with other people or persons, so that when you die, your share in the house automatically goes to that other person. Like joint tenants with rights of survivorship, for example. I think only spouses can use that. So if you and your spouse own a house as joint tenants with rights of survivorship, once you die, your spouse automatically gets the rest of your share. It doesn't need to run through probate or whatever. There's no blip. There's no, like, your spouse doesn't get kicked out temporarily while the courts figure out what to do. They just simply get your half of the house. So that's another good estate planning, estate transfer, thing to keep in mind. All right, that's all I have for comments. Let me look at the other few questions here. So Tom Potter says, this may not be something you have expertise in. My father-in-law established a trust and he has passed. Sorry to hear that. He and his widow are co-trustee, have real estate partnership income, and the partnership is registered to the trust. Once my mother-in-law passes, who is paying the partnership income tax? Yuck. He and my co-trustee. So it depends how they set the trust up, Tom. If it's probably a living trust, which is a revocable trust, which means while your father and or your mother-in-law are alive, all income in the trust is simply taxed to them on their tax return as if it was their income directly. If and when they both die, well, your father-in-law already did, but when your mother-in-law eventually dies, that trust then becomes irrevocable, and now their estate, or her estate, becomes the taxable recipient of whatever income that real estate partnership continues to throw off. I think, not 100% certain, but I think this is how it works, Tom. So that real estate partnership, which is now owned by the trust, which is practically owned by your mother-in-law as far as the IRS is concerned. Once your mother-in-law dies, her estate then owns that partnership. Whatever income is thrown off by that partnership while in your mother-in-law's estate, your estate pays taxes on it. Her estate pays taxes on it. And I believe estates are taxed like trusts, and that any income over like 13 grand is taxed at 37%. So that's not ideal. It would be good for your mother-in-law to have her estate wrapped up pretty quickly after her passing, hopefully. But not an expert there. Definitely have them work with a estate planning attorney and someone who's strong about estate taxation in their state, Tom, to give them better answers, because you're right, that's not my wheelhouse. I know enough to be dangerous with that. And final comment. Oh, here's another one just came in. So second to final comment from Paula. Can you repeat exactly which types of accounts should not have trusts named as beneficiaries? Right. So there's exceptions to everything, Paula, but generally speaking, any sort of tax-deferred account, traditional IRA, traditional 401k, traditional 403b, the traditional federal thrift savings plan, which is basically the 401k for federal employees, 457 deferred income plans, should not have trusts named as beneficiaries, because then you run the risk of all of that tax-deferred income being realized and taxed at the trust level, and trusts pay tax at basically 37% on effectively all income they have. That would be bad. You would rather have those accounts passed directly to the ultimate beneficiaries, children, relatives, churches, friends, whatever. Don't have them go through a trust. But there's exceptions. As we touched on here, special needs trusts, if and when you have a beneficiary who has special needs, that's a whole different animal. All bets are off. Forget what I said. Then it probably makes sense to leave those assets to the special needs trust. Not my expertise. So, you have to find a planner and or estate planning person who specializes in special needs planning, because that's a whole different ballgame. But in that case, the asset protection and shielding that the trust gives, so that the government services can't go drain that trust out, that protection can often be more valuable than the tax hit that trust may have to pay. So special needs trust is one exception. The other exception, again, if you're wanting and need to protect and shield the money from the beneficiary. For example, if you're leaving it to someone who has substance abuse problems and you're concerned they're going to drain the account, on substance abuse, buying things they shouldn't buy. Or if they're a spendthrift, they have no control. They're going to go blow it on pools and cars and clothes and vacations. Or if they are potentially, going bankrupt, you don't want them inheriting $1 million and the bankruptcy being like, ooh, yeah, look at that, more money to take. Or if they are, on the verge of entering a nasty divorce and you don't want the spouse to get half of that inheritance. In those cases, then, maybe you do want to leave it to a trust, because a trust can protect and shield the money from being taken out to buy drugs, or taken out to go buy lavish cars and vacations, or taken out by a soon-to-be ex-spouse, or taken out by some other creditor or bankruptcy court. So then a trust could make sense, even if it does come at the expense of having to pay higher taxes. Paula, sorry. Hopefully that answered the question. There's no one answer fits all. Like I said, there are exceptions, but generally, tax-deferred accounts should not have trusts listed as beneficiaries. Directly name the ultimate underlying beneficiaries, persons as the beneficiaries. Elaine asks, if the house is in a revocable trust, does spouse get to step up on the house basis? It should be yes. Yeah, I would think so. It depends how the trust is structured. If both spouses are joint, co-trustees, then yes. If the spouse who died was the sole trustee, that could be slightly different, but I believe the answer should generally be yes on that, Elaine. Okay, what else we got here? Okay. All right, looks like that's it. Thank you all for sticking with me as this ran over by 13 minutes or so. Hopefully you got a lot out of it. These things are wrapping up for the year. What's next month? Next week. So we got 2 more for this year, and that's it. Next week is Devin Carroll, who is a Social Security juggernaut. Dude's got like 300 subscribers on YouTube. He's got a few books. He's got a paid membership group. He's got his own Facebook group called Social Security Intelligence Members Group with 10,000 plus people. Social Security, that's his bag. That's what he does. So he's coming on next week. We're going to talk all about Social Security. Week after that will be the last one of the year, where I will be talking everything you ever want to know about Roth conversions. Timely matter, because for those of you who want or need to get conversions in before the end of the year, we're having this discussion on December 15th. So you'll still have a couple weeks left in the year to get your conversions in, if and when you choose to. All right, that's that. I'm running out of voice, so we'll cut it here, and I will see you next week. Take care.